All right, today we're cracking open the latest earnings report from Streamco, a big name in Japan's e-commerce world. And let me tell you, this one, it's a bit of a puzzle. We've got a company where sales are shooting through the roof, but profits, they're taking a nosedive. So let's figure out what's going on.
Okay, I'm going to start with the one number from this whole report that just makes you go, wow. Negative 81%. Yeah, you heard that right. Just let that sit there for a second. That is a huge drop. But a drop in what exactly?
So that 81% plunge, that's their net profit. But, and this is the crazy part, in the exact same period, their sales went up by almost 10%. So wait a minute. How on earth do you sell way more stuff but make way less money? That's the big question we're digging into.
All right, to get to the bottom of this, let's kick things off with the big picture. We'll take a look at the key numbers to understand this, well, this very mixed bag of results.
Okay, and this is where the plot really thickens. So we know sales are up, right? But check out that middle line, operating profit. That's the profit from their main day-to-day business. It's actually up by more than 19%. So their core business is doing better, it's more profitable, but the final bottom line number, the net profit, has just cratered. This definitely tells us something else is going on under the hood.
So let's talk about the part of the company that's absolutely crushing it. We're talking about their e-commerce engine. This thing is the powerhouse, the real driver behind all that growth we're seeing.
And listen, when I say powerhouse, I am not kidding. Take a look at this. The internet commerce side of things makes up a whopping 96% of their total sales. I mean, let's be real. For all intents and purposes, this is the company. So if Steam is having a good quarter, it's because this part of the business is just firing on all cylinders.
And boy, is it performing well. Sales in just this core e-commerce division shot up by over 10% compared to last year. We're talking 23.1 billion yen. This is the heart of the company, and it is absolutely humming.
And if we peek a little closer, you can see what exactly is driving that boom. It's not just random stuff. It's big ticket items. Peripherals and digital cameras, up almost 20%. Personal computers, up over 12%. Even home appliances are seeing really solid growth. So the main business isn't just huge, it's growing and getting even stronger, which of course just makes that original question even more confusing.
Right. A tale of two segments. This, my friends, is where we find our answer. The reason all those amazing sales didn't turn into amazing profits for the whole company, it's because there's a battle happening between Stream's different divisions.
And this chart just lays it all out perfectly. Look at that bar on the left. That's the internet commerce engine, just printing money. 406 million yen in profit. Awesome. But then, look to the right. That's the beauty and healthcare segment. It's not just that it made less money, it actually lost money. 13 million yen. Gone. This is the anchor that's weighing the whole company down.
So you're probably asking, what is this beauty and healthcare segment anyway? Well, it's a totally different kind of business for them. It's all about personal care products, health foods, and they even run actual physical brick-and-mortar stores. Now, you might be thinking, why would a company keep pouring money into something that's losing it? And that's a great question. Usually, it's a long-term strategy, you know? They're betting on diversifying their business, hoping this little segment will one day grow up to be a big, profitable one too.
So, let's get into the why. Why is it bleeding cash? Well, for one, sales dipped a little bit, but that's not the real killer. The big problem was rising costs. The report points directly at higher staffing costs because they've been opening more physical stores. And the result of all that? A 13 million yen loss, which is a really tough pill to swallow when you remember that this same division actually made a 20 million yen profit last year. Ouch!
Okay, so whenever you see a profit number drop like that, it's natural to wonder, is the whole company in trouble? Is this a sign of a bigger crisis? And to answer that, we have to look past the profit and loss statement and check out something even more important, their cash situation.
And you know what? The news here is actually really good. Forget about those weird profit numbers for a second. The company's core business is an absolute cash machine. And trust me, in the world of business, having a lot of cash flowing in is like having a strong heartbeat. It's a fantastic sign of a healthy company.
This chart really breaks it down for us, where the cash came from and where it went. See that giant bar on the left? That's almost 1.2 billion yen that flowed in from their main operations. And those two smaller negative bars? That's them putting that cash to good use, investing back into the company and paying off some debt.
Honestly, this is a textbook example of what a healthy company does with its money.
And here's the bottom line, the number that really matters. After all was said and done, after the money came in and the money went out, their bank account was 785 million yen richer in just one quarter. So yeah, this confirms it. Despite the profit headache from that one division, the company as a whole is sitting on a really solid pile of cash.
Okay, so now that we have the full picture, let's wrap this up by looking ahead. What does the company itself think is going to happen for the rest of the year? What's really interesting here is that Stream hasn't changed its forecast. They're sticking to their guns. They still see sales growing by over 5% for the whole year, but they're also telling everyone to expect operating profit to be down about 15%. And you can bet that's because they know they still have to deal with the problems in that beauty and healthcare segment.
And so, all of this leaves us with the one big question for Stream's future, right? They've got this incredible e-commerce business that's powerful, profitable, and generates a ton of cash. The challenge for them now is, what do they do about the part of the business that's dragging them down? Can they fix it, or will they need to make some tough decisions to really let that amazing core business shine?